Now that we are clear about the idea of diversification and the benefits that diversification brings to the portfolio in terms of a reduction in the risk, right? Reduction in risk. We do need to try and address the issue of how much diversification, So how many stocks should the portfolio have when you are diversifying the portfolio, right? So that's something that we're going to address in this particular section, along with broad benefits of having a certain number of portfolio stocks in the portfolio. Plus, we will also discuss a little bit about what is the individual security specific risk that comes to the portfolio when you add a security to the portfolio, something commonly denoted by a term known as beta, right? So let's discuss first in terms of diversification. Now, we've already seen the benefits. If we keep adding securities to the portfolio, usually the risk of the portfolio keeps coming down. So if we were to plot, let's say, something like the risk of the portfolio on the y-axis and the number of stocks on the x-axis. Typically, if you have one stock, you have a certain risk, and then as you keep increasing the number of stocks, the risk will keep coming down. But what would logically happen is that beyond a point, the risk going down, the rate in fall of the risk, first it'll start at a faster rate and then it slows down over a period of time, right? And then it stagnates. So logically, the risk cannot become zero when you have stocks in the portfolio because there will be some finite risk. So beyond a point, the curve would become flattish, and we will reach a point that when we add stocks to the portfolio, for a while the standard deviation falls. But then if you keep adding more stocks to the portfolio, the reduction in risk is not as much, right? Now, there are mathematical formulae which will suggest that as you keep increasing the size of the portfolio, as you keep increasing n, where n is equals to size of portfolio, then beyond a point, the reduction in risk becomes smaller and smaller. But to kind of get this data from live markets, what we are going to do is we are going to look at data with respect to four portfolios, the following four portfolios. One with Tata Steel, a stock Tata Steel and only that. The next one with the top 30 stocks in Bombay Stock Exchange, BSE, including Tata Steel. That is known as an index called Sensex. Then the top 100 stocks in BSE, including Tata Steel, that's an index called as BSE 100. And then the top 500, which is BSE 500. Right? So obviously in the first case, we're looking at one stock. In the second case, we're looking at 30, then 100, then 500. And then we have to kind of identify what is the risk that each of these portfolios have. Four portfolios, four different risks is what we are going to calculate. We're going to calculate risk in the form of standard deviation, and we will do that with respect to live market data. So for this, we are going to look at data that we have available for the last 1 year. So what are we looking at? We're going to look at data for the last 1 year for the four portfolios. Portfolio 1 including only Tata Steel. Portfolio 2 including BSE Sensex, which is the top 30 stocks, which includes Tata Steel. Portfolio 3 including BSE 100, which is the top 100 stocks. It includes BSE 30 as well as Tata Steel. Portfolio 4, which is BSE 500, which includes 100, 30, and Tata Steel, of course, right? We have the data for this for the last 1 year, starting 1st of April 2015 all the way down to 23rd of March 2016, almost 1 year of data, right? Now, remember the calculations on standard deviation and volatility, as we have discussed this in the past, will be done on returns of these stocks. So how do we calculate the returns? Today's price minus yesterday's price divided by yesterday's price. That gives me the return for Tata Steel for the particular day, BSE Sensex for that day, BSE 100 for that day, and BSE 500 for the next day, for the same day, right? Now, we can double click it. So we have returns for all these portfolios, four different portfolios over multiple over this period for the period of the last 1 year. Now we can try and find out what is going to be the variance of these portfolios. So the first thing we try and find out is the variance. Remember, these are daily returns. So what we will get is daily variance. So we can use a formula called var, which is going to give us the variance, and select this data. We can also use a formula in newer versions of Excel called var.s. var.s is the variance for the sample. var.p is the variance for the portfolio. var.s will give you the same data as var. And this is what we see, what we have calculated. This is daily returns variance, variance in daily returns. We already see that individually Tata Steel has a bigger variance than what the market would have. How do we annualize it? Remember, if you annualize it, there are 250 trading days in the year, approximately, cutting for holidays and Saturdays and Sundays when the stock market is trading. So you take the daily number and you multiply with the number of trading days, which is 250, right? That's your annualized variance. That's what we are going to do to calculate the annualized variance. What do we calculate that as? So 0.08 multiplied by 250 in percentage terms. That's what the annualized variance is, correct? Now, the next stage that comes in this discussion is basically going to look at what is going to be the annualized standard deviation, because we're talking in terms of standard deviations. Remember, standard deviation is the square root of variance. So I can just find the square root using a function called sqrt, and we get the square root of variance, which is 43.5%. And now let's look at the data more carefully for the individual stocks and the portfolios, right? Now you see that when you have only Tata Steel in the portfolio, the volatility of the portfolio is 43.5%. When you add another 29 stocks to it to make it BSE 30, volatility falls to 17%. When you add another 70 stocks now to take it to BSE 100, we now see that there is no statistically significant change in the volatility. It stays about the same. It doesn't really go down. In reality, it actually goes up a little bit, but that we could ignore in terms of probably data points around a few stocks here or there. For all practical purposes, it does not decline. It stays where it is. And then when you add another 400 stocks to the portfolio, you find it doesn't move after that either, right? So 40% going down to 70% when you have 17% when you have 30 stocks, and then the next 470 stocks don't really add anything, right? The next 70 don't do anything, and the next 400 in the BSE 500 also don't really reduce the risk dramatically. So what this tells us is that there are limits to what benefits diversification is going to give us, right? Let's summarize what we have just seen. What we are seeing is that when we look at these stocks in the portfolio, when we have only Tata Steel in the portfolio, we have a standard deviation of around 40%, right? So we'll plot that curve again. As you keep increasing the number of stocks in the portfolio or securities in the portfolio, and you plot the risk here, the risk goes down faster initially and then it becomes stagnant. So when you have one stock, the risk is about 40%, 43 to be precise. When you have 30, the risk is about 17%, and then it continues to stay at 17%. It doesn't really fall too much. So this concept, when you have many stocks in the portfolio, let's say you have 500 stocks in the portfolio, you're basically owning the entire market for all practical purposes. Then in that case, the extra benefits don't really come in. This scenario is called as over diversification, right? Now, over diversification does not add any value in terms of reduction in risk, but it will take away some value. It will create a problem because there will be an effort in order to monitor and study those 500 stocks, right? Monitor 500 stocks. Earlier, if you are in this portfolio 2, then you only have to monitor the top 30 stocks. If you're in portfolio 3, you have to monitor 100, and if you're in portfolio 4, you have to monitor 500 stocks. And for no real additional benefit in terms of reduction in risk. The risk does not really go down beyond a point, right? So what this real life practical data suggests is that diversification is good, but only to a certain limit. Once you have a portfolio of the size of 30 to 40 stocks, for all practical purposes, whatever benefits diversification had to achieve in terms of reduction in standard deviation, all benefits have been achieved there, right? Beyond this, if you keep adding more stocks to the portfolio, it does not really change things dramatically, right? So for all practical purposes, you can use this top 30 stocks in the BSE as what we are going to call as the market portfolio. Because beyond this, if you keep adding stocks, obviously market portfolio, technically speaking, should be all the stocks that are existent in the market and you add all of them. But in this particular context, you will have to kind of rely on a scenario where we see that 30 to 40 stocks actually reduce the risk to the maximum amount of level. After that, you keep adding more stocks. It doesn't really reduce the risk as much, but it does increase the effort that we will have if we are a portfolio manager in terms of monitoring and tracking all these stocks. That doesn't make sense, right? That's an additional effort for not really achieving any reduction in risk at all. This is the concept of diversification. And we realize that even in real life, there are a lot of fund portfolios that have stocks of around 60 stocks, 70 stocks, 80 stocks. You will see that the actual benefit occurs only at about 30 to 40 stocks. Beyond that, it doesn't really add value, right? As I said, there is a mathematical formula around this entire discussion as well, but we'll refrain from using that formula at this stage. We'll probably come back to visit that formula at a later stage. What it suggests is that as you keep increasing the number of stocks, first the rate of fall in risk is faster, then it kind of stagnates. There is no real material statistically significant fall in the risk as you keep adding more and more stocks to the portfolio, right? So that's about diversification and what is an optimal amount of level of stocks that you have in the portfolio. Next stage that comes in is talking about what is the risk that one particular stock adds to the portfolio, right? That is given by basically something called as beta, right? We will revisit our discussion around the risk that a portfolio carries in terms of systematic risk and unsystematic risk, right? Systematic risk is market risk which cannot be diversified. Whatever can be diversified, company or industry specific risk, they can be diversified through portfolio diversification. Once you reach the market portfolio, once you have reached the market portfolio, the risk that cannot be diversified away is now known as the systematic risk, right? That's known as beta of the portfolio. Now, if you add another stock to this market portfolio, the individual stock specific risk that it'll add, which is the systematic risk, it cannot be diversified away anymore, is known as beta of the portfolio, right? Beta of the stock that comes in. Let's understand what is the beta. Now, beta is a measure of risk a security adds to the well diversified portfolio. Let's understand it in two concepts. We'll look at it in the form of a conceptual definition and then a technical definition. Conceptual definition says it defines how much a stock moves when the market moves by 1%. For example, if beta of a stock is 1.2, if the market moves by 1%, the stock will move 1.2%. If the market falls 1%, the stock will move minus 1.2%. So a beta of 1.2 means the stock will move 1.2 times the market, right? A beta of 0.7 means the stock will move 0.7 times the market. If the market goes up 10%, the stock will go up 7%. If the market goes down 10%, then in a zero point 0.7 case, the stock will fall 7%, right? Obviously, higher the beta, higher the risk the stock adds to the portfolio because it's more volatile than the market. It moves more than the market, right? Technical definition, if you just regress, do a simple linear regression of the stock's returns with the market returns, The slope of the line you get is what is called as the beta. It can also be found using the formula beta is equals to covariance between the stock returns and the market returns divided by variance of the market, right? Technically, what you're doing is this. You have a curve where basically this is the 0 point. This is where you are plotting the market returns. This is where you are plotting the stock returns. Now, on any given day, you could have a variety of combinations of what the stock returns are and what the market returns are. For example, on one day you could get a point here. On another day you could get a point here. Third day you get a point here, then here, and so on and so forth. You could get a variety of combinations over, let's say, a 1 year period on where the market returns and stock returns are. When you regress these, you are basically plotting a line through this entire curve, right? This line will take the form of y is equals to mx plus c. That's what linear regression is. Y here is the stock return. Stock return is m times the market return plus some constant. Ignore the constant. This m here can be written as stock returns is beta times the market return, right? So effectively, you are trying to find out mathematically the slope of this line, and the slope of this line is going to give you beta. Remember, we said beta of 1.5 means that if market return is 1%, the stock will move 1.5%. That's what this line gives us. That's what the technical definition is. And that's what your covar between the stock and the market returns divided by variance of the market returns is going to give us, right? That is the technical definition of beta. Let's try and calculate beta for our stocks. And in our example, we're again going to look at the example of Tata Steel. And for the definition of market portfolio, we're going to use the market portfolio as the BSE Sensex, the top 30 stocks, right? So let's look at this here. We already have the prices for the last 1 year for Tata Steel. We also have the prices for BSE Sensex. We have already calculated the returns for these two. We've removed the other data points. Can we now find out what is the covariance between these two data points, right? For that, we can use a function called covar. We can use covar or we can use covariance S. Anything is fine. So we can use, let's say, covariance S, and you take this data. Covariance requires two arrays, so you use both the data, select it. In fact, let's actually use this separately. So we'll use covariance.s and open the function argument. You see these arrays coming in. In array 1, just select the entire returns of Tata Steel. In array 2, just select the entire returns of the market and click on OK. That's the covariance we find. How do we find the variance of the market? That's variance S, and you just select all this. We've already calculated this as well, right? So we have covariance, variance of the market. The formula suggests covariance divided by variance, right? That's what the formula suggests. Covariance divided by the variance of the market. So we take A and we divide by B. We get 1.56 as the data, right? 1.57. So in our definition, the slope is coming out as 1.57, which means if the stock moves, if the Sensex moves 10%, then the stock of Tata Steel is expected to move 15% or so approximately, right? Now, remember, this is assuming historical relationships exist in future. This does not mean it has to happen on a day-to-day basis. It's quite possible. Remember, here also it was not 1.57 on every day. It's just that the best fit line that we find, which is found by linear regression, that's the best fit line. The slope of that line is 1.57. So it's expected that over a period of time, if you keep recording these instances, on average, you will have a 1.57 times move in the stock of Tata Steel when the market moves by 1%, right? Now we can also calculate the same instead of using, if you for some reason don't remember this formula of covariance by variance. Remember, we are drawing a line and we can just use the function slope. There's a function called slope. It asks for two arguments known y's. Now remember, our argument said y is equals to mx plus c. Y will be the stock return, right? So the stock's returns are y and x will be the market returns. So the market returns are x, and if you click on this, you will find the same value of beta coming out of this function as well, right? The same value of beta coming out of this as well. So you can use beta slope function here to arrive at the value. Even if you do a linear regression of these two, which can be done using some tools in Excel, you will get the same value. What does it mean? It basically means that if historical relationships exist in future, the Tata Steel stock will move 1.57 times that of the market move, right? If for some reason you end up finding a stock that has a beta of less than 1, then essentially that's where the stock becomes a slightly less risky stock as compared to the market. So let's quickly summarize this. What we have said is, if beta is greater than 1, typically stock is expected to be riskier than market, right? If beta is less than 1, it's less risky than the market, right? Beta equal to 1. Now 1 is market beta. The market moves one time itself. So if the stock's beta is 1, it'll move exactly as much as the market moves, right? So for all practical purposes, beta is a number that can vary anywhere between 0 and any number higher than 1 as well is available. There are stocks with beta of 2, etc. as well, but you will find increasingly rare that there are such stocks in the market. On an overall level, remember that beta of 1 will be the market. So if you have a market portfolio, the beta of that should be equal to 1 for the market portfolio, right? That's logical as well, because the market will move 1 times itself. It can't move more than itself or less than itself, right? That's the understanding of beta. We will look at other ways of calculating beta as well at a later stage, but broadly, this historical method of calculating beta is used, and that gives us broadly historically what has been the relationship between the movement of the stock and the movement of the market, right? And as we end, we have our usual idea of a quick couple of questions. Explain what is meant by beta and explain what is meant by over diversification. Thank you.